Our options journey is just like any Mario game. We fail over and over and over again. But that's okay. It can be against different enemies or on a different console. It doesn't matter, it's all the same because as we all know, failure is a part of the learning process. And there's no way to avoid it. The only way is to learn from it and try not to repeat the same mistakes. Fool me once, shame on you. Fool me twice, shame on me. So as long as we learn from our mistakes and we fail forward, then everything's fine. In this video, I'll go through 2 of my biggest mistakes early on. So hopefully you can avoid repeating them. Welcome back, mindful investors. I'm Rob, and I'm just here to share my journey and how I implement 10 plus strategies for investing in the stock market. From the buy and hold dividend stocks to the 10x conviction plays, I try to cater for everyone at every stage of their investing journey. We scroll all the way back to 2008. So back then, Apple was trading within like a $5 to $7 range. My mindset back then was that things were going a little bit slow. Even going from $4 to $7 within like a 3-month time frame was too slow for me. That's when options came in. I was like, why? Why am I only making 50% off the stock when I can make 5x or 10x off the stock options? Let's try it. And that was my first biggest mistake. I believe it was here in Christmas of 2007. That's the year when iPhone launched. The run up to Christmas that year, we hear that iPhones just sold out everywhere. People were just driving to the States and buying all the iPhones they can because they didn't launch here in Canada. The major countries that carried it back then was the US, Germany, France, and UK. So in North America right here, we can't get it in Canada, so everyone is just driving down. That's when I kind of sense the imbalance between the supply and demand. The demand is way up here and the supply is just down here. So that's why I was bullish on the stock, especially in the Christmas season. So the play I made was a long call. The long call saying that they'll blow out the earnings season in January. So I made this play close to around here, a week before Christmas, so at $6.50. That's why I made the play. I believe I went for a long call for $8, around 2 to 3 weeks away. The earnings was like maybe January 7th to January 9th. That's around the second week of January. So that's when I made the play. It was fine the first weekend of the play because it's gone up. It's gone up from $6.50 to $7. So that was a 10% gain in the stock. But for my options, I was up like 30%. I was like, oh, I should have bought more. But then here comes the crash. So that was a peak in December 28th, $7.14. And over the next 4 weeks, it dropped all the way to $4.64. $4.64. So if we pull out the calculator here, 474 divided by 718, that's a 34% drop over the course of 4 weeks. And what do you know? Just this first spike down from 714 to 612 was enough to demolish my option contracts. I was up 30% up here at the peak, and automatically over the course of 10 days, these call option contracts have lost 90% of its value. I was just in shock because I never lost that much in that short of a time frame. 10 days for 10K. That's how much I lost. And to put that into perspective, my whole account, my whole portfolio at that time was only 25K. And somehow I managed to put 40% on this one play that expires in 3 weeks. Even if the stock remained flat for the next 3 weeks, I would have still lost everything because the time decay ate into my premiums. So that was a write-off. And after this play, I quit. I pretty much said I quit options. You can lose 90% in 10 days. I was like, no more options. That's why I told all my friends, don't ever touch options. It's the most dangerous instrument that can lose you 90% over 10 days. Don't ever touch it. That was my number 1 advice. Reflection number 1, stay ahead of the game. In my Apple play, I was very late to the party. I made the play just 2 weeks before the earning. But the majority of the gains came from the iPhone announcement back in July. From July to December, the stock price has already gone up from $4 to $7. That's where the meat of the fish is. You can find my analogy in this video. It kind of describes a similar play, but executed to almost perfection. So in hindsight, I did learn from the Apple mistake to tweak all my future plays. And I did quit the options game for a good 5 years until I went to Hong Kong. Around 2013, that's when I got back into the game. Because in Hong Kong, everyone loves to gamble. They like to speculate, they like to go for 5x, 10x, that's all we talk about. So that's when I got back in the options game. I went for long call, long puts here and there. I did manage some small wins, like 3x here, but then you lose more than you win, right? So I think overall, I was up a little bit because if I was continually losing, I'll probably quit the game again. Until I met this guy, I think he owned like 5 to 10 condo units in Hong Kong. And as we all know, their units there are insanely expensive, so he was well off. His net worth was maybe like 10 mil plus USD, plus minus. And we talked stock market a little bit. I talked about how I speculate on certain stocks. I speculate on Tencent, the Hong Kong Stock Exchange, and I was just talking about the plays I knew, the long call, long puts. And he was like, okay, I see what you're getting at. You're going for the home runs. But for me, like for himself, with like 10 mil assets, he was saying like, I just short put the market. I short put the S&P, I short put the NASDAQ, I just short put the indices. And at that point, I was like, what the hell is short put? Maybe I need to get on that because this ultra rich is doing it. So I need to learn about short put. So essentially what short put is the opposite side of what I was doing. So while I was making all these long plays, he was on the other side, collecting my premiums. So essentially he was taking all my money. And I was like, that sounds like a pretty good business to be in. You just be the banker. It's like being a house at the casino. You collect the premiums here and there, the game is on your side. And then I was like, okay, this ultra rich is doing it, there's gotta be something there. If I ever wanna get to that status, I'll just sell these option contracts. So from then on, a good 2 years, I was selling contracts, making these long call plays here and there, and overall, I was up. Okay, so here comes a wave that made me quit options a second time. It was a play on Disney. Disney 2016 December. That's when they launched a blockbuster Star Wars movie. They haven't released a Star Wars series for the past 10 years. So the anticipation is huge for this movie. And I was like, okay, let's make a bet on it. I'm bullish for this Disney earnings season. I'm not gonna make the same long play bet. I'm gonna stay safe. I'm gonna short put Disney over the next 3 months. And then here comes the pain. Here comes the second crash. So as we see here, in November, the stock peaked at 120. But then it tanked all the way to like $90 within the next like 6 weeks. And all this time, I was selling puts. So every time it dropped like 5-10%, I'm gonna sell 10 contracts of Disney. Since the stock was around $100 range, so 10 contracts times 100 shares per contract times $100 per share. For every block of short puts I sold, I was buying 100K in shares. Since it crashed down so hard, I was left with a whole bunch of shares. At its peak, I was holding like $1 million in Disney, and the stock price just kept crashing down. So I was getting margin calls left and right. I couldn't hold on to these shares. And ultimately, I sold off when it hit rock bottom at around $80. So 120 down to $80, that's like a 35% drop. But my whole position was down like 300K. 300K. That's when I call it quits in the options game for the second time. Because somehow, some way, I was going for premiums that tallied for maybe 10K in total, but I lost 250. I lost 250 on a 10K bet because these are naked puts. So I have to use all my margin to buy all the extra shares. That was breaking down. In hindsight, the risk and reward didn't make any sense. The reward was 10K, the risk was 250. So 25 to 1. Reflection number 2. Risk management is everything. Just like the Chinese saying, 赢粒糖輸間廠, that's exactly what happened here. I was trying to win this candy, but I'm losing my whole factory. Like, that is not the type of risk and reward I want. I need to be able to cap my risk. And there's 2 ways of doing that. You can cap your risk by managing how many contracts you're selling. You're not just selling a number of contracts to gain that premium. You're selling that contract because you actually want to buy those shares. And you can actually afford to buy those shares and hold on for the long term. If I limited my contracts down to maybe 1/3 of that, I would have held on to every single share. And even when it dipped from 120 to 80, it doesn't even matter. Because right now the stock price is 200. Like I had the vision for the long-term play, but as I mentioned many times, in the short term, anything can happen. And the second way to risk manage is using a different option strategy, as by using the bull-put spread instead. If you put the bull-put spread on, we know exactly how much we're risking for how much reward. Normally, I put like a 5 to 1 odds, so in order for me to win that 10K, I would be risking 50K. Then with the odds laid out on the table, you can really evaluate if you want this 5 to 1 bet. So knowing the exact risk versus reward before getting into the trade is critical. You can find an example on my video right here. So after that, I called it quits again. I called it quits again in February of 2016. And for the next couple months, I didn't make a single trade until my next conviction play in Pokemon Go of that year. That saved me and brought me back into this options game. If I didn't have this huge win in Pokemon Go, it's very possible that I would just quit this options game once and for all. So the main takeaway from my option failures is that it's a chip in a chair mentality. No matter what you do, you have to manage your downside. Like in my Apple and Disney cases, in both instances, it got wiped up by 40%. That's the max pain I was willing to take because of this chip in a chair mentality. I know that if I have a chip, I can slowly grow it. I can slowly grow this chip back to my fortress, back to my 100%. But if we didn't risk manage and we lost everything, even if you have the next opportunity of a lifetime and you can get 100x, 100x times 0 is still 0. If you found any value in this video, check out my stock option playlist right here. Again, thanks for watching, take care, and I'll see you in the next one.
Here we go again!